Why do so many investors make a solid plan, then abandon it the moment the market gets exciting or uncomfortable? That question gets to the heart of delayed gratification. The basic idea is simple: choosing to give up a smaller reward now for the possibility of a better outcome later. In investing, that might mean not chasing a sudden price move, not selling just because headlines feel scary, or not taking a quick gain if your original thesis still makes sense. The marshmallow test is often used as a symbol for self-control. Whether or not that idea predicts real-world outcomes in every setting is more complicated and depends on how it is studied and interpreted. But as a framework, it is useful. Investing constantly presents versions of the same choice: act now to relieve emotion, or wait and follow a process. That matters because markets trigger impulses. When prices rise fast, people feel fear of missing out. When prices fall, people want relief. When a trade is slightly profitable, people may grab the gain early just to feel successful. When a position is down, they may hold too long because realizing a loss feels painful. Delayed gratification helps because it creates a pause between emotion and action. But patience in investing is not just sitting still. It only works when it is attached to a clear decision framework. A framework means rules or standards you use before emotions take over. That can include entry timing, position sizing, holding period, and risk management. Entry timing is simply when you choose to buy or sell. Delayed gratification can help here by stopping impulsive entries. Instead of jumping in because a chart looks exciting or a headline sounds convincing, an investor may wait for specific conditions that fit the plan. That does not guarantee a better result. It just reduces the chance of acting for emotional reasons alone. Position sizing means deciding how much of your capital goes into one idea. This is where patience and self-control matter more than many people realize. A person may be patient about waiting for a setup, then lose discipline and place too much money into it. That is not delayed gratification. That is concentrated emotional risk. Risk management means setting limits, so one wrong decision does not do outsized damage. Holding period means how long you expect to stay in an investment or trade. Some strategies are short-term, some long-term, and neither is automatically better. What matters is alignment. If your plan is long-term, reacting to every short-term fluctuation can break the strategy. If your plan is short-term, calling it patience when you ignore your exit rules may just be avoidance. Here's a hypothetical example. An investor buys based on a defined thesis, not because of a rumor or a sudden move, but because the investment meets pre-selected conditions. The investor also sets a risk limit, meaning a point where the position will be reduced or exited if the idea is not working. After a short time, the investment shows a small gain. The investor now faces a delayed gratification decision. Take the quick reward now, or continue following the original thesis and risk controls. There is no certain correct answer. The future is unknown. The longer-term thesis may work, or it may fail. The point is not that waiting is always smarter. The point is that the decision should come from the plan, not from the emotional comfort of locking in a small win. Now compare that with the alternatives. One alternative is impulsiveness, reacting to every price move, headline, or opinion. That can create overtrading, meaning too many trades made without a strong edge. Another alternative is rigid passivity, calling yourself patient when you are really refusing to update your view. Good delayed gratification sits in the middle. It resists short-term emotional pressure, but it still responds to new information when the process says it should. This is where a common misconception shows up. People often think patience is always a virtue in markets. It is not. Patience can help reduce emotional mistakes, but it can also turn into indecision. Waiting too long can mean missed opportunities. Refusing to act can be just as costly as acting too quickly, depending on the strategy, market regime, transaction costs, taxes, and other factors that vary by investor and context. There are also real limits to the marshmallow test comparison. Investing is not a simple guaranteed trade-off between one marshmallow now and two later. In markets, the later reward is uncertain. You are not being promised more for waiting. You are accepting uncertainty in exchange for the possibility that your disciplined process has a better expected outcome over time. That distinction matters. So the practical takeaway is this: delayed gratification is useful in investing when it helps you follow a process instead of your impulses. Before you act, know what would get you in, how much you're willing to risk, what would prove you wrong, and how long the idea needs to play out. If patience is part of the plan, define it in advance. If action is required, define that too. The goal is not to always wait. The goal is to make decisions that are intentional, risk-aware, and consistent under uncertainty.